Welcome to this explainer. When most folks hear the words accounting rules, they tend to glaze over a bit. But I am thrilled to have you here today because we're actually going on a fascinating journey. We're going to take what seems like a dry, rigid set of rules and transform it into the ultimate GPS for business profitability. Seriously, if you've ever wondered how the most successful companies know exactly where to trim the fat and where to invest, it all comes down to the journey of a cost. So get ready because we are going to demystify cost accounting once and for all.
Okay, let's dive into this. What you're looking at here is a glimpse of our source material for today. It's a dense, highly technical, multiple-choice question bank covering hundreds of accounting scenarios. It looks like absolute chaos, doesn't it? But don't worry, I promise you that by the end of our time together, we're going to take this chaotic wall of data and organize it into a highly logical, incredibly powerful toolkit for business management. So, here's our game plan for today. We'll start with the cost accounting landscape, then decode business cost behaviors, move on to tracking inventory and labor, make sense of overheads, match costing to production, and finally wrap it all up with budgeting and variance analysis. All right, Section 1, the cost accounting landscape. Think of this as the GPS for your business.
Let's kick things off with a fundamental question straight from our source. What is the primary objective of cost accounting? It's really easy to assume accounting is just logging transactions so you can file your taxes, right? But actually, that's financial accounting. Cost accounting is a whole different beast. Its main objective is to build an internal system to actually control those costs and help management make smart decisions. It's not about staring in the rearview mirror at history, it's literally about steering the ship. Which brings us right into Section 2, decoding business cost behaviors. Basically, how these costs actually act out in the wild. And this brilliantly illustrates a super fundamental concept in business: fixed versus variable costs. A fixed cost, like the rent for your factory, it just sits there. It stays exactly the same whether you produce 1 unit or 1,000,000 units. The bill is the bill. But a variable cost, that fluctuates directly with your activity level. Think of your raw materials or the factory's power bill. The more you produce, the more you pay. Grasping this split is absolutely crucial for predicting your profit margins. Now, we also need to talk about how costs are traced. I like to think of a direct cost like a laser beam. It hits a very specific, identifiable target, like the exact steering wheel installed into a specific car. Boom, traced perfectly. An indirect cost, though, that's more like a floodlight. It illuminates the whole factory, like the salary of the factory supervisor. You absolutely need that supervisor to build the cars, but you can't easily pin down exactly how many cents of their salary went into one single vehicle on the line. And hey, we can't talk about decision-making without hitting on this vital definition: opportunity cost. Simply put, it's the cost of the opportunity you forego. Resources are always limited, right? So if you choose to use your factory to make product A, you are actively sacrificing the profit you could have made producing product B. The path you don't take still carries a very real, relevant cost, and management has to weigh that. Moving on to Section 3, tracking inventory and labor, or as I like to call it, the core ingredients. Basically, your stuff and your staff. Managing your inventory is totally a tightrope walk. You want to keep costs down, but you definitely can't afford to break your supply chain. Our source lays out 3 big techniques here. First up is economic order quantity, or EOQ. This is all about finding that mathematical sweet spot between the cost of ordering stuff and the cost of storing it. Then there's just-in-time. This slashes your storage costs because materials arrive exactly when you need them. But man, it increases the risk of running out of stock. And third is ABC analysis, which classifies your inventory based on its annual value, so you know exactly which items need the tightest security. All right, pivoting from the stuff to the staff. What is the actual role of a remuneration system when it comes to managing labor costs? Well, according to the source material, it's a massive balancing act. The goal is to attract and keep top-tier talent, but also to strictly optimize expenses. Basically, you have to pay enough to get the absolute best work, but structure it so the business still turns a really healthy profit. And how you structure that pay completely changes how your costs behave. Let's compare them. With a time rate system, workers get a guaranteed wage for a set number of hours. It doesn't matter how much they produce. It's stable, sure, but if production slows down, your cost per unit shoots right up. Contrast that with a piece rate system. Here, workers are paid purely based on how many units they pump out. You've essentially turned a fixed time expense into a pure variable cost. It definitely drives efficiency, but you do have to watch out for a drop in quality if people start rushing. Okay, Section 4, making sense of overheads. We've tracked the visible materials and labor, so now we're tackling the invisible costs.
Now, what's really interesting about this slide is how we tackle one of the notoriously trickiest parts of accounting, allocating indirect costs. The question straight from the bank is, what is activity-based costing, or ABC? If you have a massive factory utility bill, how in the world do you fairly chop that up among all the totally different products you're making?
Well, the answer is activity-based costing. It's a cost management system that assigns overhead based on the actual activities being performed. So instead of lazily spreading that utility bill evenly across everything, ABC looks for specific cost drivers. For example, it might allocate costs based on the number of machine setups or the exact hours of machine time a specific product requires. By using multiple drivers, you get a phenomenally accurate picture of what a product actually costs to produce. It's a real game changer. Next up is Section 5, matching costing to production, because you really have to fit the costing method to the maker.
See, a custom printing press just doesn't track costs the exact same way a massive oil refinery does. Our source beautifully contrasts two main frameworks. First, job costing. This is for customized products, like printing a batch of totally unique wedding invitations. You track and trace the cost individually for that specific custom job. On the flip side, we have process costing. This is for the continuous production of identical, homogeneous items, like bottling a soft drink. You can't track the exact cost of one single drop of soda, right? So instead, you average the costs of the whole department over a set time period, across thousands of identical bottles. Now, when you're running a massive process, like brewing chemicals, you are going to have some loss. But, and this is key, not all loss is created equal. Normal loss is inherent to the process. Think about liquid naturally evaporating while it boils. It's completely unavoidable and management expects it. But abnormal loss, that's unexpected and usually entirely avoidable. We're talking warehouse theft or a forklift crashing and breaking a machine. Separating these two types tells management exactly what is just the cost of doing business versus what is a full-blown emergency they need to fix right now. And let's not leave out the service industry. The source points us to operating costing, which is a method designed specifically for them. If you're running a hospital or a transport company, you aren't pumping out a physical widget. Instead, you accumulate costs based on the service provided, like tracking the cost of a patient day in a hospital. Let's move to Section 6 and see how this all builds up. Section 6, budgeting and variance analysis. This is all about controlling the future. To plan ahead, obviously, we set budgets, but there is a huge difference to understand here between static and flexible budgets. A static budget is just that, static. It doesn't move. If you plan to sell 10,000 units, your static budget only shows the cost for 10,000 units. But what if you actually sell 15,000? That is where the flexible budget steps in. It actively adjusts for those changes in your activity level. So while the static budget gives it an initial baseline, the flexible budget gives you a realistic apples-to-apples benchmark to evaluate how your team actually performed at that new higher level of output. Now, I know looking at standard costs and variance formulas can trigger some instant math anxiety, but stick with me. It's actually a beautifully simple cause and effect pattern. To figure out our variances for materials or labor, we just take what we expected to pay, subtract what we actually paid, and multiply that by the volume, either the quantity or the hours. We are just surgically isolating exactly why our real costs strayed from our plan. Did the supplier hike their prices? Or were our workers just having an inefficient week? These formulas cut through the noise and give you the exact answer. So, the crucial point is, why do we bother with all this math? Because we are hunting for the ultimate win. A favorable variance. That means after all the tracking, allocating, and analyzing, your actual costs ended up being lower than your budgeted standard costs. You ran leaner and smarter than expected. By breaking those variances down into materials, labor, and overhead, management can literally point to exactly where the money was saved and make sure the right people get rewarded. And that brings us to the end of our cost journey today. I want to leave you with one final, pretty provocative thought. If your business isn't systematically tracking these cost behaviors, your inventory, the overheads, and the variances, how much profit are you actively leaving on the table every single day? Cost accounting, as we've seen throughout this explainer, isn't just about recording history. It is absolutely the master key to unlocking true business profitability. Thanks so much for joining me, and keep exploring those numbers.